Thank you everyone for coming. This is tax reform is pretty hot these days. The tax reform proposal that had been presented by the GOP, the destination-based cash flow tax, is, for the last year, it seems to be off the table. We at CPA have always been in favor of a USWhat, or goods and services tax, which is a tax on consumption within the U.S. But we're also looking at a territorial or a corporate income tax that taxes all companies, whether it's domestic or multinational or foreign, to the extent that they sell in the U.S. One of the problems with tax reform, as the GOP is trying to do now, or what Dave Camp, the former Ways and Means chairman, tried to do a few years ago, is adjust corporate rates and take a look at exemptions, deductions, and loopholes and the like, without addressing the fact that many big companies are shifting their profits overseas through internal transactions called transfer pricing, which make it look like they earned income in tax haven jurisdictions like Bermuda and Ireland, just through sort of internal transfer pricing. And so they're not taxed on that. That's called deferral. They're not taxed on what appears to occur overseas. Income overseas. So Bill Parks has been a longtime proponent, and CPA has now adopted policy in favor of formulary apportionment, which, as Bill will describe, shores up our tax base and makes it impossible to shift profits overseas so that domestic companies are not discriminated against, while multinationals and foreign companies strip profits and make them appear to occur somewhere else. And so it's all based on the proportion of a company's sales in the U.S., whereby if a company exports and they have a proportion of sales outside, that reduces their U.S. tax bill. So while it is not directly in the mix right now at the Washington level, I don't think they're going to succeed with the current version of tax reform, which so far doesn't have a lot of specifics, because the GOP is not united and the Dems will probably oppose. But there is a lot of soft support for formulary apportionment, so you get a shored up tax base, and again, it doesn't discriminate against domestic companies, and they can actually set, either if they keep the same rate with this formulary apportionment, they can raise another $130 billion, or alternatively, they could cut the rate by 9% and still get the same tax revenue. So Bill Parks he's a former professor of finance, started his own company that was called Northwest River Supply, now called NRS Inc., out of Idaho. And he understands the business world. He understands the tax world. He's been on the Hill many times discussing formulary apportionment. He gets what transfer pricing does, and in fact could even do it himself at times with his overseas plant. So he's comes to us with a very lot of knowledge, and with that, Bill, Bill's also a CPA board member as well. Bill, I'll turn it over to you.
Thank you, Michael. Almost 10 years ago, I learned that multinationals paid little or no corporate tax, and at first I was curious, but then I got outraged, both as a businessman and a citizen. Luckily, I stumbled on a 2007 Hamilton Project paper written by Professors Kimberly Klausing and Ruben Aviona. It really was a wonderful tutorial and everything you need to know about corporate taxes and how multinationals avoid them. You might want to look it up. How big is the problem? As Michael said, Professor Klausing made an estimate based on 2012 numbers of over 100 billion annually, and that was 5 years ago. Jeff Ferry, CPA research director, has shown by another method that Michael was quoting that the numbers were even greater in 2016. There are actually 3 different studies and they all point the same way within a few dollars, or a few billion dollars, I guess I should say. So how do companies strip these profits out of the U.S.? They use one form or another of what is called transfer pricing. Although the U.S. suffers from profit stripping out of the U.S., the same problems occur in other countries such as the U.K. Starbucks UK, despite bragging how the UK operation is a great success, told the UK Revenue and Customs Service that it lost money every year. How'd they do that? Starbucks Switzerland, which was a tax haven, purchased the raw coffee beans from around the world. Then they weren't just coffee beans, but Starbucks beans that could command a premium price. And then they were roasted with a secret formula in the Netherlands, another tax haven, further increasing their price. But that wasn't enough, so Starbucks UK was also charged 6% of gross revenue for the use, excuse me, of the Starbucks name, logo, etc., by Starbucks, the Netherlands. Result, losses every year in relatively high-tax UK. As the Tax Foundation's Gavin Eakin said, a tax system that retains any vestige of transfer pricing must be rejected. A transfer price is the price at which divisions of a company, such as Starbucks, transact with each other, such as selling raw coffee beans and the roasted beans. Starbucks also sells supplies such as napkins and cups between countries. By inflating or deflating the prices, profits are moved from one subsidiary to another. Transfer pricings are used when individual entities of a larger multi-entity firm are treated and measured as separate entities. Because the U.S. has a global tax system, worldwide taxes are levied. But if the products are, as they say, permanently invested, then the tax can be deferred. In effect, a perpetual interest-free loan by the U.S. to the company. Good deal, right? Fixing corporate tax avoidance and deferral problems is simple. Take the percentage of a company's sales in the U.S. Make that the percentage of the company's worldwide pre-tax book profits that are taxed in the U.S. These tables show an example of how it works for the ABC Corporation. Under the current tax system, ABC reports a good sales year of $10 billion with a 10% profit. But using transfer pricing, ABC can book all its $1 billion in profits in its foreign subsidiaries, just as Starbucks UK moved all its UK profits to the Netherlands. These now foreign sales would technically fall under the 35% rate in the U.S., but because of the deferral of overseas profits, ABC pays $0 in tax until they bring the profits home. They pretend to permanently invest the funds outside the U.S., so they never have to bring it back to the U.S. Now let's fix that broken system with sales factor apportionment. ABC still reports sales of $10 billion with 10% profit. But using sales factor apportionment, ABC Corporation's profits are apportioned. ABC would be taxed on the 40% of its worldwide sales that are in the U.S. But while the 40% $400 million is taxable, the $600 million they truly made overseas can come home with no tax penalty. This is a territorial system that works. We already use that principle to tax corporations in many states, including California and Georgia and many others. California would say to a company, if 17% of your sales are in California, then 17% of your taxable profits are in California. And that should be the end of it. How would I feel if my company was paying 34% federal tax and another 7.4% in Idaho taxes, but my competitor paid nothing? For a tax-avoiding multinational, state taxes don't matter, because when a multinational strips the income out of the U.S., the states can't tax it either. This is simply unfair. The customer is a neutral observer for whom companies compete. The customer doesn't say, "What can I do for you?" The customer says, "What can you do for me?" Unlike corporate headquarters or production facilities, the customer is difficult to move. So if you levy corporate income taxes based on where the customer is located, that's fair to everyone. But under the present system, multinationals have a big incentive both to book profits in fictitious locations and, unfortunately, to move production and headquarters out of high-tax countries into low or no-tax countries. Taxing based on final sales would end both maneuvers. The tax rate under sales factor apportionment does not affect U.S. competitiveness in world markets. Therefore, the rate could be higher or lower, and either way, a U.S. company would be highly competitive based on economic realities, not accounting gimmicks. So competitive, in fact, that if the U.S. leads, it is likely that other countries would follow in moving to a destination-based corporate tax. The UK, for instance, if they move to it, they've been hit by not just Starbucks, but Amazon and Google and many other U.S. companies. And if they move to sales factor apportionment, they could tax those companies. Many claim that lower tax rates produce growth. The idea that big companies would invest more with a lower tax rate is bogus. They already have plenty of cash, and we know what these companies do with extra money. They pay bigger dividends, they buy back their own stock, and they grant themselves more options, as they did at the last earnings repatriation in 2004. Another justification used is that lower corporate tax rates would make U.S. companies more competitive internationally. But as mentioned earlier, sales factor is the ultimate tax weapon in competing internationally. If the U.S. changes to sales factor, rates won't be relevant in international competition. And to repeat, if the U.S. leads, others would likely follow. Lower taxes will only be useful in helping capital-constrained companies grow faster. Research shows, and I believe, that small and new companies are the ones most likely to be capital constrained. The bank wants to help you grow, but also wants to protect its investment. So it wants collateral and earnings let you invest in inventory and receivables that are good collateral. Loans are critical to most business growth, but when you make $1 and the government takes 40 cents or more, that really hurts. Therefore, I propose that to help these businesses grow, the corporate tax rate be lowered from 34 to 15% for the first $500,000 in pre-tax profit and 20% for the next $500,000. Lower rates up to perhaps $5 million in pre-tax profits would produce the most efficient growth. Lower these rates, and the companies and the economy will grow faster. For a better economy, tax all companies the same, domestic, U.S. multinationals, and foreign multinationals. However, you can in effect put your thumb on the scale for small business by giving all companies a graduated rate which starts at 15% for the first $500,000 in profits. Small businesses are the ones that are best situated to grow the economy. And don't let multinational corporations play phony accounting games to avoid paying taxes where they are owed. Thank you.
Thank you, Bill. And Jeff Ferry's research recently, Jeff Ferry, CPA's research director, found that they looked at the 10Ks. The top 87 corporations in the country paid about 14.8% tax last year, mostly because of profit shifting. And it's very hard to lower rates until you get that profit shifting is called base erosion, because corporate income is the tax base. And when you profit shift it to other countries, the base erodes, so it's very hard to set lower rates or to predict tax revenue until you fix it. So this is a companion from a territorial consumption tax, which taxes consumption here but not consumption overseas, to a territorial corporate income tax with a solid tax base where you tax corporate income that arose here but not overseas. So exports are tax-free, but companies coming in and tapping the U.S. consumer market do get taxed for the privilege. Now, there is in your GoToWebinar control panel a question area. If you could type your questions in there, and I will ask Bill orally to answer them. In the meantime, while we're getting a question, Bill, what kind of reception have you gotten from other organizations that are supportive and on the Hill?
Well, some of the organizations are, of course, CPA, the Coalition for a Prosperous America, but also the American Sustainable Business Council, some members of the FACT Coalition, but not all. They are, some of the liberals are wedded to an idea of just ending deferral, which is sort of a good idea, but it has some really bad reverberations about it. So I've also talked to a number of people, both Republicans and Democrats, mostly Democrats, and they are very interested. But the Democrats, of course, realize the Republicans are in the driver's seat. I was able to present some things to the administration. They have a tax person, tax expert, and I was able to get a half-hour meeting with her. But you know, it's a big slog because this is a complete change. And there are lots of people on the other side who would be affected negatively. And as Upton Sinclair said, it's extremely difficult to get somebody to believe something when their salary depends on their not believing it. So it's a hard thing to move, but we are making a little progress.
Right, and I'll add to that it seems to have bipartisan appeal. I've met with a lot of Republicans who, this is pretty consistent with Republican principles, at least some of them, of it's pretty simple, and base erosion is a Republican and a Democratic problem. It's not an ideology, and the discrimination against domestic companies vis-a-vis foreign and multinationals. So there's a question from Stan Sorsher. Bill, I see news stories about a territorial tax strategy which seem different from this. What is the difference between this territorial tax and the one we see in the press?
Well, I believe that the one you see in the press is just making it territorial without fixing the system. So if you don't fix the system, there is even more advantages to stripping income out of the U.S. because then you would never have to pay for it. But it doesn't stop them. And as you said, and based on Jeff Ferries and many other researchers, there are companies that pay nothing now because all that tax is deferred. So this would just take away the deferral, and it would let the company keep it, but they would continue to strip out, and it would not do anything to tax the foreign multinationals.
Right, and I'll supplement that. I mean, basically, this tax base is called our current system is an origin of income, quote unquote, origin of income, where we tax where the income appears to originate. That can be manipulated, and if you don't fix that, and you go to a territorial tax, you have a real problem with predicting and achieving any target of tax revenue. The thing about, as Bill mentioned, changing the origin of income to a destination of sales is much harder to manipulate. And so the U.S., of course, is the biggest consumer economy in the world. We have more consumption here than anywhere. Consumption and sales is what income comes from. So if you go to a destination of sales approach where you don't have the offshoring of profits ability, you get far more in tax revenue than you ever than you receive far more in tax revenue under any tax rate than that makes up for giving up the theoretical advantage of a worldwide tax system, which is really been unworkable. Next question from Hugh Campbell. And Hugh Campbell, by the way, is a CPA, certified public accountant. Shouldn't U.S. state governors, so by the way, so Hugh knows that accountants use this system at the state level right now, and companies do. Question, shouldn't U.S. state governors be highly in favor of this?
And the answer to that is yes. I don't think they're aware of it, but just my back of the envelope calculations are that the states are losing at least $12 billion a year in tax revenue because of the multinationals stripping their taxes out of the U.S. And they are limited to what's called a water's edge, so they can't tax income that doesn't show up in the U.S. So yes, the states should be going after their representatives and senators and saying, we need that money.
Right. Next question. Sorry, I have a cold like Bill does, so you have two presenters with respiratory colds. From Charlie Bloom, does sales include revenue from IP rights? Many corporations have shifted ownership of such rights to overseas affiliates, thereby evading U.S. tax.
Yes, that is a problem, but Sales Factor is the only way that I know to solve that problem. Because you say, I don't care if your IP is in Bermuda or the Cayman Islands or any one of the other tax havens, we're going to tax the percentage of your worldwide pre-tax income that is equal to the percentage of your sales in the U.S. So if 43% of your sales are in the U.S., then 43% of your profits are in the U.S. And this would affect particularly high-tech companies and also some of the pharmaceuticals that have placed their patents in various tax havens. Bermuda has a profit shows profits in Bermuda of many times their GDP. And of course, obviously, that's impossible. But that shows how this moving the profits around. But the IP would not be affected by it. It's just part of profits.
Right, and I'd supplement that answer by saying that intra-company sales among affiliates, whether it's for IP rights or roasting beans or buying raw beans or whatever, don't matter. What matters is the overall consolidated entity, the unitary entity, for example, GE, with all its controlled subs. The entity that GE reports to shareholders is the taxable entity. And so we don't care how the affiliates, based wherever, transact with each other. It's irrelevant. Instead, we care about the destination, the location of true third-party sales when that sale exits the entity when GE sells to someone else. So the profit shifting by way of IP rights all of a sudden becomes irrelevant. Charlie Bloom follows up saying, good answer, that should be a real selling point.
Yeah, it's a false problem that is often brought up by the people who say, oh, it won't work, and they bring up IP and other things. But as Michael and I have explained, when you do a common consolidated tax base like this, and so you aggregate all of the subsidiaries that the company has control of, those things just wash out because they're expenses to the U.S. company, but they were profits to the Bermuda company.
Exactly. So if there's no more questions at the moment, I have a question. Some people talk about, well, you can manipulate where the destination of your sales could occur through trying to sell to some distributor in Bermuda who then resells to the U.S., stripping out profits where you're reporting the profits to the distributor. It's called a thin distributorship problem. And Bill, what's your response to that?
Well, I think that's fairly simple because what you say to a company is all of your sales are still taxable. Just document the sales that remain outside the U.S. And in other words, where the final destination of the sale or the consumption is. And of course, a company like Apple or any of these companies, they may do lots of things to strip the earnings out, but committing tax fraud is not something that most CEOs are willing to do because that gets you years in the pen.
Right. And also VATs, which most countries have VATs or GSTs, goods and services taxes, that is a destination-based consumption tax on goods and services. And similarly, there is an incentive to manipulate where the destination of the sale appears to have occurred, because you want it to occur in a low VAT, not a high VAT jurisdiction. And so there's a whole body of law that helps parse that out to avoid unlawful, tax avoidance in that context, which can be tapped for this as well.
Yes, as the old saying that goes about love and marriage going together. The VAT that CPA is proposing fits very well with the sales factor apportionment, and would simplify the taxes, by the way, a tremendous amount. Sales factor apportionment would make life much simpler. And of course, that means that a lot of people might lose their jobs. So that's why there's a lot of pushback on this.
And that simplification, Bill, I think is because all the accounting work or evasion or work, whatever you call it, of attributing expenses to whatever subsidiary or attributing income to a subsidiary or intra-company lending, etc., all that goes away. What's the fair market value of a intra-company transaction? Was it truly an arm's length transaction? All that litigation goes away because it doesn't matter. And oh, by the way, Professor Reuven Aviona of the University of Michigan Law School is a tax law professor. He drafted a bill for formulary apportionment as tax reform. It's an extremely good bill. It happens to be 4 pages long. So the bill is simple. Compliance would be a lot simpler too. Any other questions? Okay, so I will let you know in the future on future CPA webinars. We have a couple in the works, not ready to be announced. But formulary apportionment does have a shot because a lot of offices have been informed about it. The GOP has not presented anything because they don't want to run afoul of leadership. The Dems haven't presented anything because they don't want, they're still in why should we present anything because we're being ignored mode. But one Republican office, told me one day, and I took it as a compliment. He said, you're a tax Nostradamus. Everything you've told me for the last 3 years has come true. Assuming that the Big Six tax reform fails, as I think it is now, formulary apportionment provides a good bipartisan solution for shoring up the tax base, efficiently collecting revenue, and ending the discrimination against domestic companies, and shifting our system to more of a border adjustable territorial system overall, in this case based on income. So we're hopeful. The American Prospect has been pushing it, American Sustainable Business Council, and a few others. So we'll see what happens. But thanks for your time, and we'll let you know in the next webinar. Bye-bye.